Now, so where then does that put me, right? What I need is I need to actually figure out what asset I can use that stands in for my hypothetical asset A here, right? I know the risk-free rate point is going to be true. If I can find one other asset that's always true, that I always will know the beta and return of, then I can get my line, I can calculate my reward to risk ratio or my Sharpe ratio, and I can then use that to help me understand the expected return for other assets. And luckily, I do know one other point for sure. I know that the beta of the market must be 1. And that's simply, again, because of the definition of beta. Beta is the percentage change of the asset return divided by the percentage change of the market return. And so if I'm using the market portfolio as an asset, then the percentage change of my asset, which is the market, is going to change exactly the same as the percentage change in the market. So by definition, the beta of the market is 1. And I can observe the return on the market. In a similar way, I can look at how the market has changed over time. Right? So I can go and look at the S&P 500 index is a good, useful measure of the market. There are bigger market indices. We can just observe the price change, the return on every stock in the market. Typically, people use as the market return the S&P 500 though. So, given those 2 points, I can draw a line between those 2 points that defines the relationship between expected return and beta. And this line then has a name, and it's called the security market line, or the SML. And the security market line provides us the basis for an expected return model based on the Sharpe ratio, based on the reward to risk ratio of the security market line. Right? And it's going to help us understand where stocks should fall onto the market. Right? And so what we would see here, right, we could say that every stock in the market, every asset, has to have the same relationship with risk and return as the security market line does, right? So this line must be true, and because it must be true, every other asset must have the same relationship with risk and return. In other words, if I observe some random stock, like this stock A, that has a risk, a beta of, say, what's that, 1.3, but an expected return that's significantly higher than the security market line, what do we think would happen here, right? Why does every stock have to have the same relationship? Well, if it doesn't, what will happen? Okay, so I have a stock that has more risk, right? That has the same risk as something on the line, but has more expected return. And that means that everyone would recognize that this was a great deal. For the same level of risk as all the other assets on the security market line with that relationship, I have a higher expected return. And when everybody recognizes a good deal, everyone tries to go and buy it. And as everyone rushes out to buy it, if we remember our economic rule, our basic economics, when there's really high demand, then we expect that the price needs to go up. And as the price goes up, the expected return for this asset must fall. And it falls back down to the line. And likewise with stock B, right? If we recognize that there's an asset out there that has the same risk as other assets that do have the same relationship with risk as the security market line, then everybody will recognize that as a bad deal. Right? Same risk, lower return. Nobody wants that deal. And when there's a lack of demand, the only thing that happens based on economics is that price falls. Price falls enough that expected return rises. And where does it rise? It puts that stock right back on the line. So the relationship between risk and return is self-enforcing, because if we see assets that break this relationship, then they're either overpriced or underpriced, and the prices will themselves move the expected returns back onto the line. So in equilibrium, again, because what equilibrium means is once everything has settled, in equilibrium, all assets and all portfolios, they must have the same reward to risk ratio. Because all the things that didn't have that reward, that weren't on the SML, that didn't have the same slope, they have been forced back onto the line by the nature of the market. And because they all have the same Sharpe ratio, the same reward to risk ratio, if I define the slope by any 2 points on the line, it must be equal. Because if I define the slope by point A and point M on the same line, I get the same slope. Again, that's the math. So by definition. So the slope is the rise over the run, the y change over the x change, and the y change is expected return minus the risk-free rate expected return for my asset A or for the market. And the x change is the beta of asset A minus the beta of the market, the beta of the risk-free rate. And on the other side, the beta of the market minus the beta of the risk-free rate. But I omitted the beta of the risk-free rate because it's always 0. Right? Because I know this to be true, I can rearrange this formula because inside of this formula is something that I really want to know. I want to know what the expected return for any asset A that is on the security market line might be. I want to use my knowledge, my Sharpe ratio here, to estimate the expected return for any asset. And so if I rearrange this equilibrium result, I get a formula that says the expected return for any asset is equal to the risk-free rate plus the beta of the asset times the expected return on the market minus the risk-free rate. And this is something called the capital asset pricing model. And it's the result of all that logic, right? Of trying to understand how risk and return trade off, of what the relationship between risk and return actually are. We have come up with the security market line, and the result of the security market line is the capital asset pricing model, right? And it says, again, that the expected return of the asset has to be equal to the risk-free rate. Plus the risk premium that the firm should expect, or that the asset has based on its systematic risk. Right? So some function of systematic risk, which is beta, and the risk premium of the market, right, will give us the expected return of asset A. And this is true for any asset. Physical, financial, every asset should hold with the capital asset pricing model. And unlike some of the other models that we talked about in class, like the dividend growth model, this is still a widely used model in practice to estimate the expected return of a stock, or in lots of other assets too, actually. So this is a really important one. This is a fundamental finance thing. If you are a finance major and trying to get a finance job, I can almost guarantee you that you will be asked about the CAPM. Right? I have been personally told that by Citibank recruiters that they ask about the relationship of the CAPM. What does the CAPM tell us? How does beta play into the CAPM? What does it mean? And if you can't answer that, you don't move on to the next level. So this is a really important one. All right, so we'll work a couple of examples here. Talking about the capital asset pricing model, we'll calculate some CAPM. We'll calculate portfolio CAPMs. We'll calculate betas, portfolio betas. We'll calculate the reward to risk ratio and equilibrium for a couple of firms. We'll work some more practical examples with a little more realistic examples, and that's it for chapter 13. Right? So I will get the lectures up for chapter 14 pretty quick. You guys will have homework for chapter 13, so keep that in mind. We're almost done. We got one chapter left. We're in the home stretch. I hope you guys are holding it together, and we'll see you next week.